Should you invest now or wait for a stock market crash? In this video, I'll share the research that's helping me make investment decisions right now. This is Andrew Stotz of Stotz Investment Research. Let's get started. First, we're going to talk about the U.S. stock market and the fact that it's exceptionally high. Next, we'll look at investors and how they think about the market, which they're pretty positive about the market. Then we're going to look at buying stocks at this level of valuation has led to losses. We'll go into low interest rates and show that they can't help this market much more. And you'll see that a re-rating drove the recent stock market performance. And finally, I believe that you should expect about 3%, not 16% average annual return over the next 5 years in the U.S. stock market. So let's get into the first part of this, and let's start with a chart that shows the U.S. stock market index rebased to 100 starting in December 1990. I added in my red light, green light system to this chart to show if the market is at an extreme peak, meaning the red light would be flashing, so you want to be very careful about putting money into the market, or an extreme trough. When the green light is flashing, then you would add more money to the market. You can learn more about the red light, green light system I've developed in the video I've linked in the description below. So where are we now? Also remember that the chart you will see next is of only non-financial companies. Part of that's because that's the main thing that I invest in. I don't invest in financials. Now the U.S. stock market is super high, but red light is not yet flashing. It's high, definitely. But the red light hasn't turned on yet. So what are you supposed to take away from this? The key point is the U.S. stock market is exceptionally high. My red light, green light tool is not yet flashing red. So the bottom line from this part of this analysis is stay invested in the U.S. market, but know that it is approaching a peak. Next, let's look at investors who think the market will do well over the long term. I surveyed my friends on Twitter and LinkedIn, and I asked them, what U.S. S&P average annual return do you expect over the next 10 years? To give you some perspective, the U.S. stock market was up an average 16% per year from 2009 to 2020. What an amazing period of time. As of today, the market was up 63% over the past 3 years. So, investors think the market will do well over the long term. What can you see here? 51% of the respondents said that the market should return 5 to 10%. Remember, I've asked them over the next 10 years. So, the key points from this section, the U.S. stock market was up 16% on average from 2009 to 2020 and is up 63% over the past 3 years. Most investors I surveyed expect 5 to 10% return over the next 10 years. So the bottom line, well, investors think the market will do well over the long term. Next, let's look at buying stocks at this level of valuation and how it has led to losses. In the following study, I looked at the U.S. stock market from a valuation perspective. I used 3 common measures of value and applied them to the overall U.S. stock market. The first was enterprise value to earnings before interest, taxes, depreciation, and amortization, or EV to EBITDA. Next was price to earnings ratio, or PE. And finally was the price to book ratio, PB. Let's first review the summary statistics. I calculated each of these measures of valuation for 308 months since 1990. To summarize, valuation is high. The average EV to EBITDA was 10.4 times over that period of time. The minimum was 6.6, maximum was 18 times, and the current level is pretty high at 17.2. The average PE was 22.3 times, minimum was 10.9, maximum was 38.2, and the current level is 36.1. The average price to book was 3.5, minimum was 1.8, maximum was 6.4, and the current level is that 6.4, the maximum. Finally, I grouped all 308 monthly outcomes, and then I put each data point into one of 10 groups, from cheapest to most expensive, or as we say, deciles. Let's look at this chart. We're going to look at the 5-year forward return of the market based upon what level you entered the market. When did you buy? So let's look at the chart before we get into the data. First, on the left, on the y-axis, we can see it is the 5-year annualized return. That is the average future return. It could be 10%, could be 20, could be 25%, but that would be the average annual return that you would earn if you invested at that time. Now let's look at the x-axis, and we can see the deciles. All the way to the left is the least expensive or cheap, and all the way to the right is when the market is most expensive. These are the valuation groups. Now I put them into groups mainly because you can't really compare PE to price to book to EV to EBITDA, so better just to put them into deciles. Now, what can we see from this? Buying when the valuation was cheapest, meaning least expensive, decile 1, led to a high average annual return. For EV to EBITDA, if you bought when it was cheapest, that means decile 1 on the left, you would have earned 17% per annum, per year, over the next 5 years. When PE and price to book were cheapest, you would have earned 19% per annum over the next 5 years. Now, this applied for the 3 cheapest groups, which also showed that you would have gained when you buy cheap. It goes down a little bit, but eventually, if we look at it over time, we can see, depending on where you buy the market, you get a high return. What we can see here is a roughly linear relationship. EV to EBITDA didn't give a perfect signal in decile 8 and 9 when it was expensive, but it is a pretty perfect layout when you think about it. So the question is, where is the market now? Well, there it is. The market is currently in decile 10, meaning it's the most expensive it's been since 1990. Remember that EV to EBITDA was 17.2 currently, PE was 36.1, and price to book was 6.4. So, what can we take away from this? Well, based upon 3 common valuation measures, the U.S. stock market is at peak valuation. When investors bought in the past at these levels, they had about a 3% average annual loss over the following 5 years. What's the bottom line? Buying stocks at this level of valuation has led to losses in the past. Now, let's go in and look at low interest rates, because that's a topic that people always talk about. But what I would say is low interest rates can't help this market much more. Let's look at some data provided by Professor Robert Shiller. I accessed Dr. Schiller's data on his website to plot the next chart you're going to see, which is a long-term chart of PE and inflation. Now, I just used PE. I calculated PE. I did not use the Shiller cyclically adjusted PE ratio for many different reasons. We all have seen that, but I just want to look at simple PE. Let's look at the chart. Here we can see that 40-year, the blue line is inflation or consumer price index. We have a 40-year inflation down cycle, and that has driven the PE up to the same level as a dot-com bubble peak. Remember that low inflation has led central banks to keep interest rates low, which naturally boosts valuation in the calculation of value. When interest rates fall, the value of the stock price goes up. But the question is, will interest rates go lower? Yeah, they could go negative, but by how much more? I think it's unlikely. In fact, I think that inflation will start to rise over time, and that will cause interest rates to rise. Now, you may ask the question, Andrew, why didn't you talk about that big peak in the red line? You can see the note to the left as to why the PE was 83 times around 2008, and it was mainly because banks had huge losses, so earnings went to almost nothing, therefore PE shot up. That's not a very reliable signal, in my opinion, so that's why I don't focus on that 83 times peak. So what's the key points? Well, 40 years of falling interest rates and the recent decade of rock bottom rates has supported the rise in the PE multiple. These low rates have driven that PE ratio to an all-time high of 36 times. What's the bottom line? Low interest rates can't help this market much more. All right, now let's look at how a re-rating drove the recent strong performance. There's four main components of stock market return. First, you get compensated for inflation. Second, you get some dividend yield. Third, you get the book value growth of the company, and then something I call the dream factor. All of those things combined give us the total stock market return. If you earn 10% in the stock market, we can divide it into these different factors, and that's exactly what I do. So now, let's look at each of these factors in a little bit more detail. Inflation. When you invest in the stock market, you are going to be compensated for the general rise in inflation, 1 or 2%, but we can say that that's one component of stock market return. Next is a dividend yield. Each year, you're going to receive cash paid from companies' profits, which we divide by the share price. And of course, if you buy the overall market, you're receiving all the dividends from all the companies in the market. Then you get real book value growth. Companies don't only pay out dividends and buy back shares, they also grow their internal book. As an owner, you benefit from the growth derived from the profits that have been retained in the business. And finally, is the dream factor. So let's talk about this dream factor. What do I mean by this? Well, investors are willing to pay a higher price for the same amount of earnings or book value, then they're driving up the dream factor. And when they are only willing to pay a low price for the same amount of earnings or book value, they drive down the dream factor. For experts in the financial world, you'll recognize that the dream factor is a PE, or price to book multiple re-rating. A re-rating would increase the dream factor, or a D-rating, which would decrease the dream factor. I call it a dream factor because it's all about what investors are expecting in the future. Some people call it a re-rating. Now let's break down the stock market return into these four components. This is the U.S. stock market. And here we can see. And the first thing we see is that inflation, the small brown bar there in the stacked bar chart, that inflation is always positive. Next comes the dividend yield, which is always positive. Next comes the real book value growth, which tends to swing a bit. And in fact, in 2020, we saw that the real book value growth actually went negative. That's the first time it's gone negative since 2008. And it also went negative in 2000. So it happens, but I suspect that's going to be bouncing back in this year of 2021. And finally, the most volatile factor is the dream factor. That's the market basically ramping up prices, as we saw in the period of 1994, 1995, 1996, and as we've seen in the current period. So let's look at that for a moment. Generally, what I say is that when the dream factor is high, meaning the red bar is high, that it's probably going to eventually lead to a collapse in the dream factor where people will turn negative. And that's really what I've seen. In fact, 9 of the past 12 years saw a multiple re-rating or the dream factor rising. So part of what I'm doing is expecting that we would see that happening in the future, that there would be a D-rating in the dream factor. Now, the number that you see on the chart is the component that the dream factor is in the total return. And in the years 2019 and 2020, it's been 21% of the total return in the market. Now, let's consider what $100 invested in the U.S. stock market at the end of 1990 grew to become. Well, if you invested $100 in 1990, it grew to be $1,785 by 2020. Great, fantastic. Now, let's break that return down into the cumulative contributions from each of the 4 components. And here we can see the chart. And what you can see is that the long-term return has recently been driven by the dream factor. Book value growth was the second largest driver of return, which was good. And that blue bar shows that it has been good over the years. But you can really see that the dream factor cumulatively is very high in the U.S. Now, let's ask another question. Let's consider the correlation between dream factor and forward stock market return. In other words, when dream factor is high, stock market returns in the future should be low. When dream factor is low, it means the market's derated. You buy at that point, and then your future return should be high. So let's look at this chart. What we can see here is that it has a negative correlation. When the dream factor is high, it usually leads to negative returns. Now, the correlation is not perfect. In fact, you can see the highest correlation is at minus 25 for 5 years. I wouldn't say that it's a super reliable measure, but what I would say is that it gives you an indication of the direction of the market. So, the key points in this section: stock market return is driven by inflation, dividends, growth in a company's book value, and the dream factor. Also, the dream factor shows what investors are willing to pay for future earnings. And finally, the largest part of the return over the past 2 years came from the dream factor, and in the past, when it was high, forward return was negative. What's the bottom line? A re-rating drove the recent strong performance in the market. We can definitely see that in the charts. Finally, let's wrap it up by looking at this section where I'm saying expect 3%, not 16%, per annum or per year over the next 5 years. Now we're ready to estimate these 5-year returns. I take all that we've learned from the studies above and try to make my estimate of what the U.S. market's average annual return will look like over the next 5 years. Remember, this is not a prediction or a recommendation. It's just my observation. I'm not telling you to buy or sell. I'm presenting my research, and I want you to think about it. In fact, I'm going to ask you in just in a moment what you think about it. So here's where I basically looked at the U.S. total return, but this time I went to 5-year periods. So all the way to the left, you can see the period of 1991 to 1995, and all the way to the right, you can see 2021 to 2025. So these are 5-year periods going back to 1990. And basically what you can see is when dream factor has been pushed up, it tends to collapse. And there we can see the dream factor has been pushed up until 2020. I expect that we'll see some collapse in that dream factor happening from the period of 2021 to 2025. And therefore, I expect about an average annual return of 3% over the years, over the next 5 years. It could have a minus 15. It could have a plus 20, but on average over the period. Of course, this is the 21st of August, 2020. So what are the key points from this? Based on the various factors presented in this research, we expect U.S. stock market returns to be pushed down over the next 5 years, caused by a collapse in the dream factor. The bottom line, expect 3%, not 16% per year over the next 5 years. So let me ask you, what do you think will happen with the U.S. market? Should you invest now or wait for a market crash? In this video, I shared the research that's helping me make investment decisions right now, and I hope it can help you too.